This is the first tax strategy. This is called as qualified small business stock. What is a qualified small business stock, first of all? This is a kind of a tax strategy that allows the business owners to pay out little or no capital gains tax whenever they sell the stock of some qualifying business. What makes a stock qualified? Let's first discuss that. To be qualified, a stock has to be first issued from a C corporation. There has to be holding period of at least 3 to 5 years to take the advantage. It has to be original issuance, meaning thereby you cannot purchase it from another shareholder or from the stock exchange. And at the time of the issuance of stock, the company needs to have assets below 75 million. Let's take up an example. You invested 100,000 in a technology company, which is a QSBS stock. There are some categories like law, accounting, finance, which are out of this. They are non-qualified. But we will take an example of a qualified stock, which is a technology company. When you invested 100,000 in that company and you kept it for good like 5 years, and now the company's growth has been significant and the stock is worth, let's say, 2 million now. You had a capital gains for 1.9 million on that, and all of that capital gains, if you hit the terms, is gonna be exempted from them. So that's what the benefit for a
Look at the angel investors. When you're investing money into any startup, when you sell your investment, you end up paying capital gain taxes. So this is an incentive that's given to encourage people to invest money
for a long term.
for at least 3 years.
Yeah.
When you define the long term, at minimum 3 years, if not 5 years. But if you keep the money in that investment for n number of years, then when you sell your stocks, you don't have to pay any capital gain taxes. That's the idea.
The next strategy is Delaware Statutory Trust.
DST, very, very popular.
So the name itself gives away there is a trust that is created under the Delaware law, and the DST holder owns some properties within that trust. So how this helps you? Let's say you have a rental property at hand and you decide to sell it and enter a 1031 exchange. So you can, like with this DST, instead of like there's a timeline, or if all of you know about the 1031 exchange, you have to find another lifetime property within 45 days to seal the deal. So with this, there's a situation. If you happen to not find the right kind of property, then you can enter into a DST, and because it's already professionally managed real estate business. So with this, you are not only able to complete your 1031 deferred taxes, but you are able to generate an income equal to net rental income based on the fractional share, whatever you have invested in the DST. So with this, this process can go on. You can enter and exit from one property or DST to another property in this DST and continue to defer your taxes. But here's the catch. With every DST, there is a holding period, at least for like 5 to 7 years. DSTs, I would say, they're like arranged marriages. Once you are there, you get stuck. But I must say, there's a blessing that there's a way out.
Is an alternative to 1031 exchange. Everybody knows 1031 exchange. When you sell the investment property, you can invest the money into another property, like, so we call it exchange. I'm not selling, Mr. IRS. I'm just exchanging it, so I should not be paying taxes. That's 1031 exchange by definition. There are limitations. You have to find the property, you have to like the property, somebody has to sell it at a good price, and there's limited time around it. So what if you're not finding the right property? You're not able to, you want to do 1031 exchange, you just don't have a property. DST comes in picture. Delaware Statutory Trust Company, people have registered their Delaware, their trust. They have a lot of properties. They qualify as real estate investment. So you can take your money, invest whatever money you choose into that DST and qualify for 1031 exchange, so you don't have to pay the capital gain taxes on the property that you sold.
What about the extra money?
You have to invest all of it. That's the same thing in exchange as well. Basic rules for the 1031 exchange still hold good. It's an alternate. I mean, I want to invest. I don't want to pay the capital gain taxes. I just don't have another property agent. What do we do? All practical purpose, the way it works, these DSPs are big companies, like $100 billion companies already set up. So we can introduce them to a couple of DSTs, couple of people who are running the DST. They can invest their money, they can give their money to these companies with proper contract that this is the return. The only downside is it's not something that you can park your money temporarily. It's not something that I was supposed to finish it in 6 months. It's taking 9 months. Can I park my money for 3 months? That's not how it is. Once you are in DST, they are generally there for at least 5 years, if not longer. That's the downside. People who are running DST, they know people want it. Because nobody wants to go through this whole hassle for 1031 exchange. So they have load, they have expense around. Who are managing, they have their salary, they have their income, they have, where is it coming from? From the same system. So the typical ROI on a DST is going to be lesser in theory than what you expect on a typical 1031 exchange, meaning the appreciation is used up by the system in terms of paying the salary, in terms of paying the office expenses. But there are a lot of DSTs around, but generally they are bigger stocks, but they can't really have their own DSTs.
What happens after 5 to 10 years, let's say, fund want to take out my money?
And you can go to another DST, or you can go to another 1031 exchange, or you can put it in your will. The next generation takes it, no tax. It's one of those concepts where you're building wealth as opposed to using the short-term cash flow. So all these billion-dollar entities, billion-dollar people who have the network, they became billion-dollar because in generations, somebody invested some money in New York City for $1,000 and it became $1 million. That million became 10 million, 10 million became 100 million. That's how the wealth is created.